Hi folks, Scott Lundhagen here, and don't worry, I'm driving fine. It's a highway between Calgary and Edmonton here. I can do this in my sleep, no problem. Won't get into any accidents. As a matter of fact, I'd be sleeping if I wasn't talking to you right now. Thought I'd take the time to do just that. So just pretend you're sitting in my car with me. We're going to have a little chat, a little bit of a one-sided chat, but I think you'll find it worthwhile. Sometimes people ask me the question, what is debt consolidation? Now, many people know what it is, but some people don't. So I'm going to elaborate a little bit more about what exactly debt consolidation is and why you would do it. Many people today, especially these days, find themselves inundated with debts through credit cards, lines of credit, car loans, even mortgages. Now, you have to understand before we get on this thing, there's two basic types of credit. The first type of credit is negative credit. Negative credit is what I call the type of credit that goes towards buying assets that do not appreciate, assets that depreciate, as a matter of fact. So clothing, food, cars, anything of that nature you use credit to buy for is basically negative debt. The other type of debt is positive debt. Positive debt is what gets you into an investment. For instance, buying a house. A house, generally speaking, goes up in value, as it has been for the last 50 and so on years, been going up in value continually. So generally speaking, investment is a good real estate is a good investment, and getting a mortgage to buy property is positive debt. The other type of debt the other type of investments are like investing in stocks, bond, mutual funds, although these days with what's going on in the United States and around the world now, those haven't been such a great investment. But generally speaking, those type of consolidation loan to get is one by called positive debt. So if anything, you want to have positive debt and not negative debt. So a lot of people are finding themselves inundated with negative debt. They have a lot of credit cards, car loans, and so on with a lot of payments. And maybe the payments are very, very high, and they're feeling stressed by it, or they're just concerned that they're going to wonder how they're going to pay off this stuff before they retire. So debt consolidation means taking all of those loans, everything, and putting them into one loan. Now, if it's an unsecured loan, to get them is very difficult, especially these days now when lenders are clamping down. You want to be able to get a loan, and in order to consolidate your debt, so to put all your payments into one loan, and hopefully it's a smaller payment. Unfortunately, if it's an unsecured debt, unsecured loan, then your payment's going to be quite high because the bank's going to want to see it paid off very, very quickly. They don't want to have a loan hanging out there for too long without any security on it. So they're going to want you to pay it off very quickly, and so the payment's going to be quite high to pay it off. The best type of consolidation loan to get is one by way of a mortgage. All right? So, for instance, you've got, let's say you own a property worth $300,000 and you owe $285,000. And you've got $40,000 in short-term credit, meaning you've got credit cards, you've got car loans and lines of credit, maybe you owe some money to Revenue Canada, maybe you owe some money to a dentist, maybe a telephone bill or two, who knows? So you got $40,000, and supposing your payments were $1,000 a month on that debt. Well, if you got a debt consolidation mortgage, okay, you could stretch that thing out to a much longer period of time because the lenders are much more confident because they know they've got security for the loan. So they're willing to lend it out over a much longer period of time, and plus they know that real estate generally has a tendency to go up in value, and it doesn't really, at least it doesn't stay pretty stable. So they're willing to lend a long, long time, and it's secured against land, and of course they're not making that anymore. So against the land, they'll go up to 25 and 35 years. That way, your payments get really, really small. And so in the case of $40,000, where the amortization originally on that means the period of time it takes to pay it off, might have been 3, 4, 5 years at $1,000 a month, well, if you put it onto a mortgage, they can stretch it out to 35 years, in which case your payments, depending on your interest rate, your payments could be as low as $200 a month. So $200 a month. It goes from $1,000 a month down to $200 a month. That's a savings of $800 a month right there. And that's what a debt consolidation loan can do for you. right on the face of it. When you look at it, it reduced your payments by $800 a month. So that's how a mortgage can do it. Now, some people think, for crying out loud, how can that be? How can the payments be that small? I've actually had clients ask me, is it legal? Well, it certainly is. And if you want to look at it this way, this is how it works. You know those little rubber bands that go around broccoli, all right? And they're blue or pink, and they're about that wide, and they're about that thick, all right, when they're not stretched out. Those particular, that's a good example of the way it would be over a short term, over your short-term debts when it's in credit card form. So they're shorter, but your payments are about that big. So your payments can be quite big, but the period of time is fairly short. But making those payments can be very, very uncomfortable. So what you do is you take that same elastic band and you stretch it. And if you stretch it out, got to have my hand on the wheel here, if you stretch it out over much longer distance or period of time, then that elastic, that rubber gets thinner, very, very thin. Okay? That's the same thing as your payments. Stretch it out over a longer period of time and your payments come very, very thin. And if it's stretched out over a long enough period of time, then your payments can be very minute. So if you're talking about $40,000, putting it on a mortgage, either a first mortgage or a second mortgage, to stretch it out over that longer period of time, then your payments can become very, very small. That's why $40,000 down with payments of $1,000 can easily be dropped down $100 a month, save you $800 a month. That is debt consolidation in a nutshell. If you want to find out some more information on what I've got for you with respect to debt consolidation and debt elimination, then just go to my website, ramyourdebt.com. That's RAMYOURDEBT.com. There's tons of free, great information on there. I want to make sure that you are paying off your debts as quickly as possible, taking the stress out of your life. I've had it before in my life, some 20 years ago, and I eventually had to declare bankruptcy. It was a nightmare. So I have determined to help out as many people as I can, keep away from that. So go to my website, get the information, and we'll see it sometime in the future. Come back. Thanks a lot.